it's a time of change. There's a major shift going on in the dollar, and now that's changing. We have inflation, we have other issues, and when you talk to people about gold, it makes them uncomfortable. U.S. stock markets have been just galloping along this year, especially the tech stocks that are focused on artificial intelligence or AI. But many of the narratives that are driving these price increases are false. I'd also like to see Treasury revalue the gold stocks. I think the Treasury should be a buyer of gold until it gets up to $7, $8, maybe $10,000 an ounce, because that's where it belongs.
Christopher Whalen, investment banker, economist, author, and chairman of Whalen Global Advisors. It is a true pleasure to host you on Palisades Gold Radio today.
Hey, my pleasure. Appreciate the invitation.
Excellent. Excited to hit the ground running talking gold. And I oftentimes like to lead with this question, but I think your answer will be especially insightful seeing your background. We're in the midst of an incredible bull run in gold. The metal's up over 55% year to date. However, zooming out a bit and talking big picture perhaps, Chris, where are we within the longer term cycle for gold from your perspective?
If you think of the middle of the 2000 teens as kind of the bottom, I think we're in just the early stages of an upcycle, and this is largely driven by the fact that most global central banks have decided to make gold their chief reserve asset. They're not going to stop using dollars because the dollar is such a useful currency. It comes along with the ability to finance economic activity and transactions. It's also very big. So if you're buying oil or other commodities, it's essential that you use dollars. But I think, whether you talk about the Chinese or the Russians or the Europeans, most of the big central banks have been buyers of really substantial quantities of gold. There was an interesting article in the Financial Times this week talking about how the statistics for Chinese official purchases are understated because they're hiding it and they're not selling. That's the key thing. They're a big producer. They have enormous domestic demand. People in China can open a bank account with as little as a gram of gold. So they actually encourage the ownership of gold. And yet at the same time, they've prohibited cryptocurrencies, I think. So, it's a time of change. There's a major shift going on in the dollar. In fact, I'm writing a book about gold and, to talk about this phenomenon for next year. So I think it's an exciting time, but it's also a time I think that bewilders a lot of people, especially Americans who are kind of used to the false stability of a fiat currency coming out of World War II. And now that's changing. We have inflation, we have other issues, and when you talk to people about gold, it makes them uncomfortable. So,
Chris, is it fair to summarize your thesis behind gold as two engines driving the price higher? On the one hand, you have central banks, of course, it becoming a more dominant, asset to hold rather than the US dollar. And the other hand, the second engine driving this thesis would be inflation.
Yeah, I think so. It's funny. The U.S. stock markets have been just galloping along this year, especially the tech stocks that are focused on artificial intelligence or AI. But many of the narratives that are driving these price increases are false. I think AI is one of the more extraordinary investment theses to come out of Wall Street in a long time, and it's a false one. We're not going to have generalized intelligence in machines in my lifetime, and your lifetime for that matter, because what we're chasing is a system that takes existing language and tries to use that to predict future actions. For you and I as consumers, that's great. We'll have better search tools online. When I'm writing articles, it's very helpful. But if you're talking about a company that's going to roll out AI tools, no, they're just not good enough. You have to get the error rates down to well below 1% on these systems, so we're nowhere close to that. So I think that people look to gold not so much as an alternative form of money, but as a way to get away from some of the hype and chicanery that you see in the financial markets, and also obviously the inflation of the dollar, which we've, when inflation was down in low single digits, people kind of lived with it, but when it jumps up into double digits after COVID, that becomes a political problem. You saw that we have a new mayor in New York City, an explicitly Marxist gentleman, who's promising to cap rents to address inflation. But he can't do anything about inflation. That's a Washington problem. It has to do with debt and everything else. But I think politicians generally are going to continue to focus on this because it's a pain point for consumers. So, people who are astute enough to realize that we are at an inflection point, this goes back almost 100 years in the United States, and start to not just have gold, but other metals as part of their portfolios, I think they're going to be very well served.
You mentioned that inflation is a Washington problem. I suppose you're highlighting here this distinction between the rising prices, which is, of course, the thing we're measuring when we're talking about inflation. However, if you go back to the definition, inflation refers to inflating the money supply, doesn't it?
It does. That's the classical definition. If you go back to the Austrian school, they always said that it's primarily a monetary phenomenon. That's Milton Friedman. But I also think that the obvious driver is the federal deficit and the huge amount of debt that is in the public sector today. The U.S. Treasury is the biggest borrower in the United States today. And the ebb and flow of cash in and out of the Treasury causes market volatility. Treasury just raised $1 trillion for what we call the Treasury General Account. That money comes out of the banks, comes out of the hands of investors, and it goes into the Fed. It's actually isolated inside the central bank, and then they spend it. So this ebb and flow of cash actually causes volatility in the markets up and down. You've seen the recent sell-off where most stocks and Bitcoin and everything else lost all of the gains or much of the gains for this year. And people look at that and it causes them to be, I think, fearful. So when they look at gold, which is, I think, done very well this year, and other metals too, to me, that is the obvious comparison. And it's not just gold and silver. All of the major metals, copper, nickel, I think are essentially a safe haven for investors who want to have some degree of control over their futures. If you depend on stocks as a way to fund your retirement, that's a very iffy proposition. And unfortunately, it's one that has evolved in the United States. We look at the markets as a way to finance, people's end-of-life needs. But that's really not a stable way to do it. Imagine if we had a big sell-off in stocks this year or next year, and all of a sudden people who were depending on those assets had no means of financing their retirement. That's a troubling thing. And another thing to think about vis-a-vis gold is housing. Home prices went up 50% from 2020 to today. You're probably going to see a correction in the next couple of years. That again is going to make people think, okay, how can I protect myself? And the obvious answer is to have some exposure to gold. I tell my readers they need to have at least 10 to 20% of their portfolios in gold. But think about it, the allocation in the U.S. is still single digits at best.
Yeah, that's an incredibly interesting value proposition, of course, if you're willing to look at gold. And there might be potential here to not just keep up with inflation.
Some of the big Wall Street shops are starting to go there with their advice. And I think you're going to see more of that.
Yeah, and there's definitely potential to also, of course, create real wealth if more people go into gold and, it becomes a larger part of the financial system. You could actually keep up with inflation, but also perhaps gain wealth.
Well, it's not just wealth, but, in the old days when you owned gold, it was a passive asset that sat in a vault. There wasn't much you could do with it. Today, in the gold market, if you have gold in the vault, the banks will lend against it. So you can actually leverage the asset, use those funds. There are credit cards out there and other vehicles that allow you to own gold and essentially benefit from the accretion. And I think that's a good thing. People need to have alternatives to this monopoly of fiat money that we've had since Abraham Lincoln. And don't get me wrong, the fiat dollar is one of the great inventions of all time. Not just because it enabled a lot of growth, but because you can finance transactions in it. That legal tender dollar cancels debt. So the big problem you have with Bitcoin is that if you do lever up and borrow a lot of money to go out and buy crypto assets, well, if the price of the crypto assets goes down, you have to sell them and go back into fiat currency in order to pay off your debt. That's a big weakness in that market. So gold, on the other hand, it's not so much money, but it's a stable measure of value. It's a stable asset that countries can use to support their fiat currencies. I don't think any of the major global economies is going to go back to a gold-backed currency. That's very, very unlikely in my view.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. You're just opening up more and more threads for me to pull, Chris, but that's incredible. You were talking about nickel and the likes earlier, other metals. Are you a subscriber to a thesis like a commodity supercycle thesis, or if it's more of a thesis of holding hard assets that will do well in an inflationary boom environment? Well put, and it's of course a very interesting area to potentially look for investment opportunities. Hey, we were talking about the Treasury markets just a bit earlier. You outlined $1 trillion of refinances, or at least finances, recently. It seems that Janet Yellen and Scott Bessent have both had a trend of going for the short term rather than the long term. When you have this much debt to refinance as the United States, shouldn't you go a bit longer term? And Chris, what about this idea that Judy Shelton has made popular a gold-linked loan that you would float and that would compete with your other treasuries as an interest rate? It would make the US dollar as good as gold again, is I believe her slogan. Is this something that you think could solve this treasury problem that we have?
It's not a bad idea. Judy's a smart lady, and I admire her work. I think it's one of several things that we should do. The gold-linked bond is a good one. It certainly gives investors some protection from the overall rate of inflation. I'd also like to see Treasury revalue the gold stocks that Franklin Roosevelt stole from all of us 100 years ago and start to issue gold coins based on weight. We need to re-educate Americans as to what gold is and why it is a good measure of inflation. If the Treasury was willing to buy and sell gold at current prices, I think it would not only help force the price up, but it would give people a better indication of what the real rate of inflation is. And for people of modest means, if you could buy a few gold coins and stick them away somewhere, it would actually give them some protection from inflation. But I think the symbolic nature of both Judy's proposal with gold-linked bonds and just having gold again as part of the conversation in the United States is important. There's still a lot of laws, that prohibit the use of gold, for example, in contracts. They did repeal the prohibition on gold as legal tender. Some states have actually said it can be used for legal tender. But that's not quite where we were prior to 1933. And I still think there's some work to be done there. The trouble, of course, is that the fiat system is threatened by this. The more you have gold as part of the overall conversation as a means of exchange and a store of value, the less people are going to want to hold the dollar. And it would actually force us to probably have higher interest rates, because that's how you do it. Remember the great quote from Bagho, when he said that you can't have interest rates low for too long. What he was really talking about, this was the editor of The Economist a long time ago, is that in the old days, banks had to offer people high interest rates on paper to get gold out of their hands and into the bank. You saw this during the Civil War. People were horrified when Abraham Lincoln decided to finance the war with paper money that was unconvertible. So they hoarded gold. Same thing with Franklin Roosevelt in the 1930s. When they saw him coming into office, they were horrified. And they realized that he was going to pursue a largely socialist economic policy. So they started to hoard gold, and they had to pass a law that allowed the federal government to confiscate gold in private hands. They confiscated all the gold of the members of the Federal Reserve System, the banks. We never talk about that today. But that's the trouble, is the U.S. government is ultimately threatened by alternatives, whether it's gold or Bitcoin or any of these other ersatz tokens that people want to pretend is money today.
Chris, talking a potential gold remonetization, perhaps I misinterpreted you earlier, but when you look at the incentives that are out there for the government, it would clean up the balance sheet quite rapidly if you would revalue gold to a higher level and remonetize it. Why do you believe it's unlikely still?
Well, you need Congress to act. It's set by statute today. So let's assume Congress passed a law that said to the Treasury, you've got to value the gold at current market prices. That's fine. I wouldn't want them to sell it, though. Steve Mirren, who's now on the Federal Reserve Board, has said we should sell gold to force the dollar down, but I think he's got that wrong. You buy gold with paper to force down the value of paper, and I would urge them to do that. I think the Treasury should be a buyer of gold until it gets up to $7,000, $8,000, maybe $10,000 an ounce, because that's where it belongs. If you really assess the inflation of the dollar, say over the last 75 years. So, having that symbolic revaluation of U.S. gold stocks, I think would be important. Getting members of Congress not to try and do silly things with it would be difficult because we're in a democracy. That's always the challenge. Washington comes up with ridiculous ideas all the time. And it's only thankful, the inefficiency of the Congress and the government that keeps us safe, really. But I think you got to realize there are plenty of assets in this country that we can use to deal with our financial problems, not just gold. The assets in the United States are worth tens of trillions of dollars. So when you're talking about the federal debt at close to $40 trillion today, it's manageable. You just need to have the vision and I think the sense of purpose on the part of a future president to deal with it. Donald Trump's not going to do that. He's a real estate developer and he hates debt. So, he wants to see interest rates at 2% so the Republicans can win the midterm election next year. But we'll see.
We were talking earlier about the US dollar losing its prevalence in trade and gold becoming a asset that central banks like to own. Do you think this idea of a BRICS settlement currency that's partially backed by gold is being floated around a lot? Let's say that were to happen. Do you think it could possibly force the United States to also partially remonetize its currency to remain a dominant currency to be used in worldwide trade?
No, not at this time. The BRICS effort is essentially a formalization of barter. None of these countries have a currency that you can use for financing, which is the key strength of the dollar. If you think about COVID and the rapid pace at which the U.S. economy bounced, and then look at the European Union by comparison. The European Union does not have a unified financial market even today. We still have 25 plus nations, all of which come under the EU umbrella, but they haven't rationalized their markets. They haven't said, okay, we're going to have one banking market, one fixed income market for financing everything we need to do. They also have a very large role for government in the EU compared to the US. The bond market in the US is still enormous. And the short-term markets, for example, for repurchase agreements, which are partly the Treasury market, but also the housing market, is almost $10 trillion. So the thing that limits the BRICS is that they're really just setting up an alternative clearing system so that they don't have to deal with sanctions and all of the weaponization of the dollar that you've seen the United States engage in over the years, which I think are negatives for the dollar, by the way. But over time, does China or the EU or Japan or Switzerland want to grow their currency big enough to accommodate trade, accommodate, say, oil or any of the other big commodities? No, because it implies inflation. And they don't want to do that. The Chinese particularly are very careful. They want people to use yuan more for trade, but they're not going to grow their currency that much because it would threaten their political stability. Control is the chief priority in China, not economic growth. So I think, obviously this was a reaction against the U.S. using the dollar for things like sanctions, the Ukraine example with Russia, and other examples too. But I don't think it's going to compete with the dollar anytime soon. And let me be clear, the dollar's probably going to drift down so it's less than half of total global trade. It's probably around 70-80% of all foreign exchange transactions today. So if it goes down to half, that's fine. You're still going to see people use it because it's a free good. Other nations don't have to pay to use the dollar, and they can immediately swap out of dollars into another currency after they raise their money. The Chinese do this all the time. So I think in relative terms, it's going to decline, clearly, but that's okay. And nations are going to hold the currencies of their neighbors and their trading partners as reserves. We're going back to more of a multilateral system that looks more like the pre-World War II, pre-World War I world, I think, than what we've experienced since the Bretton Woods Agreement after World War II.
I think what you're outlining there, Chris, is incredibly interesting, that dual-edged nature of a world reserve currency. It isn't only benefits like some people make it outline. You do have negatives, like you outlined. One of those is inflation at home.
Oh, very, very definitely. Initially when people came out of World War II and the Bretton Woods Agreement, they thought, the U.S. is going to have to run big external deficits if we are going to allow other nations to use our money and pretend that the paper dollar was equivalent to gold. What we've seen, though, more recently is that there's another cost besides the external deficits, which is internal inflation. And that's the big political problem that the U.S. faces now. Everything we talk about in domestic politics today, whether it's the price of food or housing or just the fact that incomes have not been keeping pace with inflation, that colors all of our politics. That's the reason you see more and more Democratic candidates running on an explicitly socialist platform. But these people have no answers. They're just trying to get elected. The only way you could really deal with inflation in the U.S. is to address the federal budget deficit and accept a more pedestrian, slower growth sort of economy. That also has political ramifications as well, because, when you promise people high single-digit growth so that they can go out and get a job, well, that requires inflation. Remember, in the 1970s, when we were debating the Humphrey-Hawkins law that sets the mandate for the Federal Reserve, employment, price stability, they wanted to guarantee everybody a job. The ultimate legislation that came out was a compromise that said, well, we'll have the Fed target full employment, whatever that is, right? But that implies inflation. It always does.
Chris, I recently had a chat with Doomberg, who outlined that the United States is sitting on an incredible amount of hydrocarbons, natural gas, oil, and the likes. That brings me to the idea of why can't the United States not outgrow this debt that we're talking about? If energy is very directly correlated with GDP, and you're sitting on this mountain of hydrocarbons that you could use to boost your economy, why can't this debt not be outgrown by a fastly growing economy?
Oh, I think that's precisely what's going to happen. You will get through the baby boom demographic bubble, which is why we have these big deficits. A future government is going to have to exercise some fiscal restraint, perhaps not spend as much on the military as we do today. And then the natural wealth that you just alluded to in terms of hydrocarbons, other types of minerals, and also just the natural growth potential of the United States is going to deal with the debt. The dollar will depreciate, though. That's one thing that investors have to be cognizant of. But I think you can manage this in a very orderly fashion. It's not a crisis. People are always going on and on about how, there's going to be a financial crisis in the U.S. and nobody's going to use dollars anymore. I don't think that's the case. I agree with you. I think that the wealth that's in the ground in the United States and also the wealth that we generate in this economy every day is our edge versus other countries around the world.
Yeah, I think that's what really sets you apart, Chris, when I look at analysts that are analyzing this specific trend that we're talking about of the world reserve currency, the United States losing its dominant place and gaining, losing a bit of relative standing there. When you look at, for example, a Ray Dalio or the fourth turning as a concept, everyone is describing this continuous trend of fall of empire. It seems that you're arguing something else. Where do you think this difference in end result is coming from?
Look, the U.S. inherited the mantle of leadership from Great Britain at the end of World War I. The British were broke. They handed us the baton. We then get sucked into World War II in Europe and in Asia, and we rebuilt the world with inflation. We printed money, we lent people money, which we subsequently forgave. The British, for example, we forgave all of their war debts because they couldn't possibly pay us back. We learned the lessons of the Treaty of Versailles, which is that when you have big debts that are a result of war, no nation can afford to pay them back. So I think going forward, it's a good thing for the United States to see its overall role in the global economy in relative terms shrink. That implies that other nations are going to grow, I hope. But it's also, I think, good for the United States not to have this hubris that says, well, we can do whatever we want. We can legislate economic outcomes. We can borrow endlessly. And you do have socialist economists who believe that, we should just keep borrowing money. Ultimately, what that means is that we're going to turn those paper dollars the debt into paper money, much the same way you saw in the Civil War. The dollar was debt when it was first issued by Abraham Lincoln. It actually bore interest. In the 30s, the same thing. The U.S. still had the constraint of a gold standard in terms of how much paper the Treasury was allowed to issue. But over time, they pushed that aside. And in World War II, particularly, the government financed everything. There was no private debt issuance in the 30s and the 40s. It was all government big banks and large corporations that were aligned with the war effort. So this notion that somehow the world is going to end simply because we have too much debt, I think misses the point of history. We'll figure it out because everyone has an interest in this game continuing. Where else are we going to go? I often laugh when people say, oh, well, the Chinese are going to sell their treasury bonds. Okay, so they're going to sell their treasury bonds. Somebody's going to give them cash. And what do they do with the cash? Well, they can go deposit it in the bank. And the bank, in turn, will go out and buy treasury bonds. So there's this circular nature to these arguments that I think people often miss. And it's quite funny. But don't buy the doom and gloom argument. I think despite the obvious foolishness that we see in Washington all of the time, there are still enough serious people in this country that I think will figure it out.
And like you outlined, almost everyone has an incentive to, keep the system going.
Sure.
Really interesting.
Well, where are we going to go? I mean, my wife is from Uruguay, which I love. It's a great country, but it's a tiny country, largely dollarized. In fact, what people often miss is that many smaller nations around the world are de facto dollarized. Even if they still have their own currency, they've indexed much of their people's salaries, real estate transactions, trade transactions to the dollar. So how do you fix that? What do you go to? You're going to use Chinese yuan? No. You're going to use Japanese yen? No. So all of the alternatives are far inferior, and I think that's one of the things that's going to support the United States going forward.
So many more threads to pull on the long term, but being conscious of the time, I would love to transition to short-term economics for a second. When we look at the stock market equities, I believe you've outlined earlier in this interview that you think that's not really a place to be allocating currently. However, if we're confident in this inflationary boom thesis like we have been talking about recently, wouldn't these assets, companies with pricing power, also benefit?
Yes, but I think you've got to be very careful. You want to buy companies with earnings power that have not been as volatile, for example, as some of the tech stocks that have been soaring because of the false promise of AI and the rest of it. I've made a lot of money on NVIDIA. I've been in and out of that stock 3 times. But I also, having covered Silicon Valley as a banker, I know that we're not going to have applied general intelligence anytime soon. So investors always chase a shiny object. They always chase the hype. And the corporations, of course, decorate themselves with the hype because they want higher stock prices. But I do think you're going to see the tech sector correct rather significantly in the next year. And there are other sectors that are going to do better. And that's as it should be. But when I look at my own group, I follow financials. I follow the mortgage sector and fintechs. And it's fascinating. You know what the top bank in the United States was past 12 months? SoFi, which is a great company. I just opened an account at SoFi. I know a lot of people who run the firm. But basically it was tech, a little bit of crypto, which drove that stock. And you see this with other stocks as well. So you always have to be cognizant of the fact that equity managers buy the hype. Okay, whatever it is. They like to have stocks that go up a lot. And then half of this market is now ETFs. ETFs are not passive. We often refer to them as passive strategies, but they're not. When they go up, they buy more. So they're kind of like doomsday machines. On the one hand, they accentuate up moves in stock, but when prices go down, as we saw over the past week, they go down a lot. And when people are redeeming units from ETFs, it forces prices down even more. So there's a volatility aspect to the equity markets today that I think you've got to be very careful of. But let's be fair. The private equity markets are in total disarray. Probably 2 out of every 3 managers in private equity will never raise more funds because the performance on their portfolio is so bad. You have private credit, which we read about every day. I'm sure you've heard about First Brands and some of these other fiascos. Well, that's because we had too much paper money carry the Federal Reserve Board. And that money was chasing opportunities that may or may not have existed. But that may help actually the listed stocks because, think about it. If you're a big endowment like Harvard and you had just bought the S&P 500 instead of putting your money in private equity, you would be way ahead. So I think the public markets are going to do fine. But just remember, I'm a former tech banker. Tech is always about tomorrow, or as we used to say about IBM, don't confuse sales with execution. And that's really, there's an interesting guy, Jan LeCun, the former head of AI at Meta, who just left the firm to do his own startup. He has been scathing in his assessment of AI, and he reminds everybody that, remember IBM Watson? It was supposed to be able to answer questions for us. It was a fiasco for IBM. They lost millions and millions of dollars on that project because it didn't deliver usable technology that other companies could use. So remember, tech is always about tomorrow. There's always tomorrow, right? Remember the song?
And Chris, talking about the health of the banking sector and the financial sector for a second, of course, in 2008, it was one of the first or second dominoes that fell in that crash. How does the health of that sector look like today?
It's okay on the consumer side at the moment. The corporate side is where the pain is for banks. Things like commercial real estate is a bit of a mess. Interestingly, multifamily real estate, apartment buildings, are also a big pain point for the banks and also for the government. The federal government finances what you would call the more inferior multifamily assets in the big cities. So HUD, Fannie Mae, Freddie Mac are all involved in that market. They have well over $1 trillion in footings for those assets. So this time around, the pain is on the other side of the ledger as opposed to consumers. I do think you're going to see a home price correction over the next couple of years, but it won't be like 2008. In 2008, half the mortgage market was private. So when it collapsed, there was no bid for those securities. I spent several years during that period working for a big servicer that did distressed loans, and it took us 5 years to clear through the backlog of assets that really nobody wanted for years. So this time around, it's a commercial problem. It's mostly the lawyers and the investment bankers sitting off in a conference room somewhere dealing with it. But if you follow commercial real estate in the news, you'll see it's just one surprise after another. And particularly in the big cities where the politics have, like New York, for example, they like to attack landlords. They like to blame the landlords for the high cost of housing. So people don't want to invest in those assets anymore. The New York State Legislature in 2019 passed a law that basically says landlords can't recover their costs. That's not a long-term strategy. But, that is what the politics are. So I think for banks, it's okay. They're not even making 1% return on assets right now, which is not great. But the industry has done all right in terms of stock prices. It's actually outperformed the S&P 500 this year.
Incredibly insightful, Chris. And I believe for anyone watching this interview that was interested by it, they'll probably like your book. So could you tell us a bit about your most recent book?
Yes, thank you. I just reissued my first book, Inflated Money, Debt, and the American Dream. It's a relatively readable financial history of the United States. I also published the Institutional Risk Analyst blog, which is much more focused on current affairs and markets. We follow the financials, obviously. I write about the mortgage industry, which is something nobody understands. I'm fortunate that I work there, and that's how I got to understand it, but it's very difficult for most professionals, frankly, to follow the mortgage sector. That's going to be a good sector next year. As rates slowly come down, I think you're going to see volumes and profitability return to many of these mortgage firms, the Penny Macs and the Rockets. And then we also follow the fintech sector, which tends to be a little more speculative, but also interesting. We'll see how they fare in the next couple of years when we do go through a consumer recession. That's the big question. I tell my readers, if they use the word AI in the description of the company, be careful. Because, when you're underwriting credit, the machine's not going to help you. You have to do the work.
You have to do the work. Chris, this chat was so incredibly insightful. Thank you so much for your time and your insights.
My pleasure. Yeah, I look forward to our next conversation.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR Plus at www.sedarplus.ca.